You spend 10 years building a company, you begin to identify as being the founder, the CEO of that individual company.
It makes such a significant difference in their business, but it's not cheap.
Sometimes the exit coach can be the coach that helps you scale, but probably more often than not, that's not the case. So I got to understand their mentality and the way that they think. If they can get a strategic lift, they will pay a premium.
So you have to really think that through, because that's super important from a personal planning standpoint. Hello, everyone, and welcome. My name is Philip Palumbo. I'm the host of the Palumbo podcast, where we interview some of the most successful founders of businesses to learn about their rise to the top, and even more importantly, to learn about their experience with exit planning. Today, we have with us Colin Campbell. Colin Campbell has over 30 years experience. He's co-founded multiple internet and technology ventures with a combined valuation exceeding $1 billion, and is here to share his blueprint. Colin Campbell is a serial entrepreneur who's been in the trenches since the early days of the internet. He's the founder of Startup Club, a global community bringing together founders, investors, and creators through weekly podcasts and expert resources. But long before Startup Club, Colin was building and scaling companies that shaped the digital landscape. Two Cows, Hostopia, Internet Direct, Geeks for Less, and .club domains, which he sold to GoDaddy Registry. He's also a founding director of the Canadian Internet Registry Authority and has spoken at universities and conferences around the world, from MIT to Beijing Foreign Studies University, sharing his hard-earned wisdom on entrepreneurship. He's also author of Start, Scale, and Exit, Repeat, published by Forbes Books, which has become the most awarded entrepreneurship book in history with 37 global honors. Colin, really is amazing having you here today to learn about give us your perspectives, your experience. So looking forward to it. So thanks for your time today. I appreciate it.
Yeah, no, looking forward to it. This is a topic I really enjoy.
Me too. And I enjoy it a lot, Colin, because I feel like from an investment standpoint, a lot of that stuff is intangible. We can't promise clients anything, but when it comes to helping my clients with exiting their business, you could really add value in a lot of different ways, which we'll discuss today, which can increase the value of their business and put millions of more dollars in their pockets. So that's why I'm very passionate about this. And I feel like a lot of founders sort of had their head in the sand, like many of us, because you're working on the business. You're working in the business, not on the business. And that's a big difference. So I feel my goal is to put content out there to really help people open their eyes to help increase the value of their business, and on an even more important part, on the personal side. So there's three things I always talk about when it comes to exiting, which is really three legs of the stool. The first one is personal readiness. The second part is financial readiness, and the third part is business readiness. So what I want to tackle with you first, let's take a founder who has a business. He's in business 30, 40 years, and now he's thinking about exiting the business. From a personal standpoint, from your experience and what you educate people on, what do they need to understand?
Okay, there are a lot of things that founders can do to position themselves for exit. Probably the most important thing is internally recalibrating who you are within this organization. Because the fact is that most companies, when they buy a company, they often don't believe that the entrepreneur is going to stick with that company for the long haul. So generally, they're looking for a Swiss clock, right? They want a company that's run very well and almost independent of the entrepreneur. So this is a time not to beat your chest and say, look how great I did, and I did 30 years and I've done all of this. This is a time to promote your people. And this is a time to check your ego at the door and step back and allow others to take the credit and allow others to actually run the company. And when you have a company that's run by others, not the founder, it can actually increase the valuation of the business. And how do I know this? Well, I've sold a lot of companies in my time, but I've also bought a lot of companies. When I sold Hostopia, it was a publicly traded company. We sold to a Fortune 500 company, and I had the opportunity to acquire about 10 companies during the 3 years that I was at this Fortune 500 company. And I can tell you the mentality, the way that they think. And for the most part, you know, every entrepreneur talks about being supportive, et cetera. But the reality is they, given the personalities of the entrepreneur and the difficult fitting within the culture, not one of the acquisitions that we made did we have an entrepreneur stay on for more than a year or two after the acquisition.
Right.
So investors, buyers they're going to look at discounting the uh, going to look at discounting the business if it's dependent on the entrepreneur. If it's independent of the entrepreneur, then you can get a higher valuation. So that's just
Okay.
one aspect of thinking about preparing yourself for exit.
Right. Okay. So what my question was more around the personal part of this, right? So a lot of us, right? A lot of us define ourselves as who we are as it relates to our career. So if I sell my business on Friday, who am I on Monday? So just help our audience understand how they should be thinking about this and what they should expect, and how could they plan specifically on this so they don't feel like selling their business was a mistake.
Yeah, and it's all about identity. And I mean, I can tell you, like, you spend 10 years building a company, or even 5 years. Um, the reality is you begin to identify as being the founder, the CEO of that individual company. And post acquisition, a lot of founders are actually a little depressed because they lose their identity.
Right.
Um, in the book, Start, Scale, Exit, Repeat, we make a pretty clear case that entrepreneurship is not about one role of CEO or one, particular identity that you uh, see yourself with a particular company. It Start, Scale, Exit, Repeat's all about starting, scaling, exiting, and repeating. And as entrepreneurship is a trade like any other trade, and we just need to hone that trade and become better and better at starting, scaling, and exiting companies. That's our identity, entrepreneur. Our identity is not, I used to own the TLD.club, right? I was the founder of .club, which is an alternative to .com. So everybody for years was like, oh, that's the founder of .club. That's the founder of .club. And then we had the opportunity to sell to GoDaddy. We sold the company to GoDaddy 2022. And after that, I was no longer the founder of .club. But then I went on to do paw.com, another company, an e-commerce company. I went on to do other businesses as well. And uh, there's always going to be that emotional impact that's going to occur when you have to give up one of your children. It's like it's your baby. This is something you've worked on for years. My wife right now, she's going through this. We own a school here in Fort Lauderdale, and she's not comfortable. She's comfortable with the idea of selling it, but not comfortable with the idea of letting it go.
Right.
And so she's going through this sort of issue of, well, I don't know. I mean, this is the way they're going to run it is going to be different, and the teachers aren't going to like it, the parents aren't going to like it, the kids aren't going to like it. Well, they might do a better job, but that's not the point. In her mind, she's having difficulty letting it go. So mentally, we have to begin that process of identifying ourselves as entrepreneurs. That's our trade, entrepreneurship, not being the CEO or founder of one particular company.
Right. So Colin, but like, what specifically? How should a founder think about this specifically if they're looking to exit their business and they're so attached to their business and there's so much identity that is attached to their business? What would you recommend that they do as a task so when they do sell it, they understand what this next chapter is going to look like for them?
Yeah, and I was actually talking to a business partner of mine with one of our companies, the Geeks for Less, and he's just turning 60, and he's now going through a process of he's been running this for 20 years, and you know, one of the things I talked to him about was you do realize your entire wealth is tied up in this one asset.
Right.
You spent 20 years building it. It's great, right? Now, this comes from a little experience. Let me just share a little story with you, if you don't mind, Philip.
No,
Um,
please go ahead.
so go back to my 20s. We started an ISP, internet service provider, took it public, sold it for about $180 million in a stock for stock swap with a cable company. This was up in Canada. Stock went to over $1 billion. And here I'm 28 years old and I own 13% of that entire company. This was incredible. Like, just never dreamed in my entire life that anything like this would happen.
Right.
But then, do you know what happened on March of 2000? You remember that?
March, of course, yeah.
That was when a judge announced that they were going to break up Microsoft, and the Nasdaq fell from 5,000 to 4,000. Our company pulled our $50 million offering, thinking that the Nasdaq will improve. But if you remember that time, the Nasdaq went down all the way to 1,200.
March of 2000, by the way, is when I got hired at Merrill Lynch, and that was the first day. That was
Oh
the
my
first
gosh! So that was like the
of my
beginning of
career.
the end. It's the worst day to get hired in that industry
Right
ever.
at the top, right at the top, I was hired.
Yeah, right there. That's the worst. And there was the music had stopped. There were none of shares to go around. And the company that I had did a stock for stock swap with, I had actually agreed to a lockup, and the dot-com crash hit. That stock that was at $19 a share at one point, I ended up selling all my shares for 6 cents a share and lost everything. So this is not, I'm not, when this book, that was probably the genesis of the book, because it was like, okay, what happened? What did I do wrong with that particular? And one was I did an exit, 10 years building a company, 10 weeks screwing it up, right? How about that, right? Didn't really think about the exit, didn't really plan the exit, was
Right.
sort of just going ad hoc. And I agreed to a lockup. That was the first problem. So I did not have liquidity or control once the lockup was in place. And I always talk to founders and say, look, I know there are exceptions to the rule, but if you either get liquidity or control. You have one of those two things on an exit, um, and then your chances of succeeding, at least you're in the driver's seat, and you're the one who's going to determine the outcome. Even if it means making less money for me, I'm okay with that. And the second thing is, bad things do happen. Do you remember back in 2022 when we had GameStop insanity, when we had NFTs
Right.
going through the roof, those bored apes selling for $500,000 a bored ape? You had over 1,000 SPACs hit the market. I mean, we had a lot of great stuff happening, and yet people didn't take their chips off the table.
Right.
We had a crypto crash. We had after that, we had we're in an e-commerce space with paw.com, and we saw the valuations. Some of these valuations, companies like Bark, worth $4 billion at that time, and are worth $100 million today.
Wow.
So some of these industries got absolutely whacked
Right.
really badly. Obviously, tariffs, interest rates have been heavy on small businesses. Um, it actually led me to come out with a time to sell index. So if you type in time to sell index startup for your startup or for your business on Google, you can see the time to sell index. We report it monthly. And what we did, and since you're an analyst, pretty smart guy, what we did is we took the last 25 years of IPO data, we looked trough to peak, we created an average, and based on that average, the current time to sell index right now is about 29 out of 100. So we're still not in a good market, but by the way, it was like 6.8 out of 100 2 years ago when I first started the index. It was very, very low. So this is not a time to be selling. I talk a lot about that in the book, the right time to sell. But when things are good, when things are frothy, it's time to exit stage left. That's
Okay,
classic
so I
time
just want to go back to your research. I'm sorry. So you put together this research where you studied IPOs, so from trough to peak,
for 25 years. We looked at all of the data.
and you wanted to know what?
Yeah, I should explain it a little better. But fundamentally, the way that the market works, and you probably have an appreciation for this, is liquidity flows from the top. So as IPOs occur, that is a way for private equity and venture capitalists to cash out.
Right.
They below them, they will try to acquire a market or build markets. But if there's no IPOs, when the money stops, it eventually trickles down. It's a little bit of a delayed reaction, probably 6 months to 12 months, but it's a little bit of a delayed reaction. But when that IPO window shuts down, it's going to impact the ability for you to sell, and the valuations are going to fall. All right. So we looked at the number of, by the way, the number in 2022 was over 1,000 public listings, which was the top, was a record number of listings. A lot of that has to do with SPACs. And then we had 150 listings in 2023. So you can see how it
Right,
completely
right.
collapsed.
That's
The
because
market
it's
had collapsed. And when that collapses, all of a sudden the valuations for private companies go down. There's not as much desire to buy these companies because they don't have a liquidity path. Every private equity firm, every venture capital firm needs a liquidity path. So
so that's
you
when
have
that's in a
massive
situ- but
index.
that's in a situ- right, but that's in a situation where you have private equities looking to purchase businesses, which is not every transaction, obviously.
No,
There's
it's
there.
not. It's not every transaction, and there probably is some good private equity data that could track this as well, and the amount of But I haven't got into that data right now. I've just focused on sort of the top of the funnel, which is the top of the food chain, which
Yep.
is how much capital is flowing into the market at the top, and that does fuel everything below that. So what's interesting is that the number has been improving dramatically. And there are exceptions. Like if you're in the AI space, or if you're in, and this is not for real estate. This is not this is really to look at traditional sort of startups, not to look at the type of real estate that they run on their own. They're more interest rate
I
sensitive.
agree. Right, right.
Yeah, like like the dot-com crash occurred, but then real estate went up. This is really to track startups, and it's an interesting index. But what it does, it takes that emotional element out. So in 2022, the founder of paw.com, who was there, he said, you know what? We did 40 million in sales. Next year, we're going to do 60 million in sales and dot, dot, dot. And we had potential offers, for 30 million and whatnot on the table. And then obviously the e-commerce index that completely collapsed, and the valuations have compressed dramatically around the e-commerce space. Not every industry is the same. Every industry acts and behaves differently. But what I'm saying, instead of when things are good, when that index starts to show a 60, 70%, like that's the time to sell but
60, 70% what?
out of 100. So I do it's 1 out of 100 index. So like if it's right now, it's at 29.
So
So if
what does that mean exactly? So you're just saying it means 29. So what does 29 mean?
29 out of 100 is the way it's rated right now, the index. So that if it's below 50, considered a buyer's market; above 50, considered a seller's market. Now, it's not 100%. Like you can't say,
No, no,
oh,
I understand.
51% is a buyer's market, 49. And there are personal circumstances where people
Right,
might
right.
want to make a decision. But here's what most people do, and this is the wrong approach. Okay, Philip. When things aren't going so good, they say, "Oh, I just want to sell the company. I just want to get out." And this is not the time to sell. This is the time to build. This is the time to
So in your personal
buy.
view, your personal view, this is not a time to sell because of your indicator that you built.
Well, you don't even have to look at an indicator. You can look at the anecdotal evidence of the market, and see the valuations of private companies. But the reason why I like the
But what
indicator,
about? I want to just think. But what about the valuations of private companies? You think they're high right now or low?
I think they're low. I think the sentiment in the marketplace is low. Now, don't get me wrong; it's way better than it was 2 years ago.
Right.
Right? We're starting to see that.
Why do you think valuations are low?
Because we have multiple problems. One is it starts with the top of the food chain, the number of IPOs in the marketplace. Again, we saw like a 50% jump in IPOs last year over the year prior to that, right? So as we see more liquidity come in at the top, that's going to feed the ecosystem, as we'll call it, all the way down. The second issue you have is interest rates. Interest rates depress valuations for companies. Take a school, for instance. It's going to have a pretty predictable cash flow. If a buyer has to pay 6.5%, 7% SBA loan, and that would be actually a decent rate, then and the return is 8% or 9% or 10%, they're making 3%. What I'm saying is it compresses. So as the interest rates fall, that increases the valuation of business.
Absolutely, I agree with you. And what do you and do you think is there a third bullet point on that, or you think the
Okay, well,
IPO?
there is the element of and I talk about this in the book as well, where if you're in a hot space or you're able to position yourself in a hot space, Like I'm invested in an accounting software company, and 5 years ago, I met with the owner. I said, like, you need to position this as an AI accounting firm, right? And AI is hot right now. Obviously, now you can't just slap a label on it and say, "Oh, I'm AI now." You have to actually be AI. You have to actually
Right,
transform with the
right.
times, right? When we first did Hostopia, it was a hosting and email company. We were basically an application service provider in 1999, 2000, and then we became a software as a service provider, and then we the SaaS, and then we became a cloud computing company, right? But we have to move with the times, and so there are other elements to uh, uh, positioning yourself and getting a higher valuation. And in particular, I spent a lot of time on the book talking about finding the right type of buyer. And if you want, we can go into that as well.
So, Colin, and I don't want to digress. So really
Yeah.
quick, what is your personal view about SaaS companies now in this current environment? Do you
All
believe
right.
it's
So
bottom
yeah.
line is do you believe it's true that AI will be taking over these companies like Salesforce and ServiceNow and CrowdStrike as an example?
So I'm definitely biased towards SaaS companies. I love SaaS companies. I think the models are great.
So do I.
I do think that AI. I'm also biased towards AI, and I do think AI can wipe out a lot of um, per- types of companies. Let me give you an example here. If it's a company that has a particular technology to make contracts and it's been proprietary technology, that kind of stuff, that's going to be challenging for those companies to continue to move forward. But where companies can do very well, like Salesforce.com, or there's another one I'm following right now, Descartes is a logistic company, is when they have all these hooks into multiple. The valuation isn't the software, so we have to get over that concept. The valuation is not the software; it's the hooks, it's the connections, it's the distribution. And when you have those hooks into proprietary data or these hooks
Right.
into um, those are the things. Now will eventually APIs and all these kind of things go away because an AI can talk to an AI. That could happen, but I think that if you have it's more like a franchise now. That if you have the connections in a particular industry and you have the data and it's proprietary, I think you're pretty solid. I think
Yeah.
that's been overdone.
All right. Sorry to. I just wanted your feedback on that. Okay. So
Yeah,
the
yeah,
all right, so we talked about personal readiness, right? Kind of that when you sell your business and then we talked about one of the key things is being is anybody's firm, not being dependent on the actual owner itself. That helps with higher valuations.
yeah.
Well, the other thing I want to talk about, which I think is really important. So, for example, if I were to sit down with a founder over lunch of a business, and I would to say to them is, have you done any exit planning? They may say to me, "Well, I'm not ready to exit," and I would say to them, "Well, it's not a question of being ready to exit. It's a question of being exit ready at all times, and building your business to that level." Do you agree with that?
I don't know about at all time, okay? Because you're going to go through a start phase. You should be thinking about the exit. And by the way, when we started Dot Club in 2012, we thought we want GoDaddy to buy this company. Okay, so we thought about it from the beginning. Okay, you should be thinking about it. But then when you're in the scale phase, again, you're not necessarily thinking about the exit. You're not necessarily positioning to exit because you're building wealth. You need to prove the concept. You need to scale it. You need to have it go. You need to get the benefit of that scaling, right? You need of the fuel that the rocket fuel that you've got, and it's going up quickly. You want to get some of the benefit. But what we want to do at a certain point is identify the key metrics in a particular industry. If your metric is earnings per share, then there are things we can do the year before to optimize earnings per share, right? There are changes we can make. Sometimes you might, instead of going for those long-term contracts where you're not going to get the benefit for years, you might focus more on short-term contracts. There might be some cost reductions that you can put in place. Uh, you know, there are some things you can do to prepare in advance, including taking yourself out of the equation, which I talked about earlier as well, so that you're ready for when the time comes to sell. But we're going to want to look at what are the things in your industry. So, for instance, in e-commerce back in 2020, the key metric was sales, right? So, one-time sales was basically the going rate for e-commerce companies. That's not at all the key metric today. It's six. in our space, because we have a brand, paw.com, we're probably talking 6 to 8 times earnings.
Right.
That's your metric. So you want to try to optimize your company a year or two in advance for the
Right.
metrics that the buyers are looking at in your
So stop.
industry.
Let's stop right there. And I agree with you. I know where you're going with this. So in terms of doing that, do you recommend? So if I'm a business that I'm thinking about selling in 2 3 years, I got past that first phase like you just talked about. Now I'm just thinking more like exiting over the next 2 to 3 years. So as far as like step by step, so you want to improve your earnings. So if I'm working with just regular Mr. or Mrs. local CPA, do you recommend hiring somebody of higher caliber who can put together a great quality of earnings and really help improve your business versus again just some type of local CPA? So tell me about your thoughts around that.
Yeah, I don't know. I mean, it depends on the size of your business we're talking about here. Obviously, if you're a
Let's just say it's a business doing revenue of 50 million.
yeah, no. So then that at that point you do want to start bringing in the best, right? The best people who can help you maximize value on exit, and like even brokers, like hiring the right type of brokers is very important as well. If you're a smaller business, you're a couple $1 million, you're gonna have to do this yourself. You're gonna
Right.
have to figure it out yourself. You're gonna maybe use AI to help you guide you through the process here, but but if you are larger, you do want to think about those metrics that buyers are looking at, and how do we optimize the company over the next year or two to generate those metrics, and that's the key way to sort of prepare for it. And then other than that, put your ego aside, step aside, and promote your people, not yourself.
Right. So in a situation of earnings, which allows us to do with accounting, et cetera, as far as having somebody and hiring somebody to come in and more or less be a business coach to improve and to maximize the value of your business, do you agree with that?
Okay, so I tend to be more. If you're at $50 million, you probably have the right accounting people in place. But I'm with you on the
Not
coaching.
all the time. Not all the time, though. Believe it or
I'm
not.
with you on the coaching here because in 2006 I brought in a CEO coach, Patrick Thean from Rhythm Systems, and it changed our company. And what we did though is we brought in 2 days of strategic planning, 90 days of execution, and this is a scale strategy here. Okay, we talk about a lot in the book about how to scale your business by using a coach, but your coach can absolutely help you get to that exit, right? And in fact, we just um,
Who is it, Colin? Who is the business coach that you just talked about? What is his name?
Patrick Tian, he runs a company called Rhythm Systems, and he wrote a book about this as well, and about the idea of goal setting and strategic planning. 2 days of strategic planning, 88 days of execution, quarterly goals, annual goals, 3-year goals, individual goals, red, yellow, green. Like we took the company that I was sort of running on an ad hoc basis, and we brought in all these systems to help us grow. And let me tell you, I mean, we were stalled in 2006. We were publicly traded, even to the point where one of the board of directors came to me. I was CEO as well, and suggested that I step aside and let a professional run the company.
Right.
And so that's when I started to think, maybe I do need some support here. And I brought him in, and we went from 18 million or 20 million in sales. This is a software service company, SaaS company, and to 80 million or $70 million in sales in 3 years. Company sold to a Fortune 500 company, 17 times EBITDA, by the way,
Wow.
17 times EBITDA. I mean, that's what we're talking. It was really, really cool. And we were publicly traded as well at the time. So, it was fascinating, but we couldn't have done it without a coach. So if you're into, I don't think you should wait to exit mode to bring in a coach. I think when you go
Totally
from
agree.
start mode to scale mode, you start to bring in a coach.
Correct. I
And
agree.
just this week, we launched the Scale Workbook. And in there, it was just funny. I was thinking about that. In there, I have a coach needs assessment, uh, um, and it includes what is your goal for exit as well. So it's interesting how that is correct. When you bring in your coach, they need to understand your goal for exit as well, because they're going to help you achieve that exit at a higher rate. But I think of it more of a strategic planning for the executive team than
Right.
just an accounting function.
Right. So Colin, I don't. get paid for coaching, right? It's part of what I do to help my clients and bring in the right team to assist them with this situation. So I'm not saying this for my benefit, just so everybody
Yep.
knows. What I want people to founders to understand is that if you bring in a business coach like you're talking about, it makes such a significant difference in their business, but it's not cheap to bring in these coaches, right? So the cost can be anywhere from $20,000 to $50,000, or maybe sometimes even more than that. Would you agree with that?
Oh, absolutely. Like I paid that back then. I was paying almost 80,000 a year for that.
For that,
Right.
right? So
Look at
right,
the impact it had. So, but that's a different than an exit. Like I understand where there's a lot of value for someone to come into an organization and say, okay, in order for you to, because you know what I'm talking about now about optimizing for metrics for the buyer and all, you know, most people don't know this stuff, right? But there's a lot of value for an exit coach to come in and say 2 years before they sell, to say, okay, here's what you guys really need to do, and lay out a formula for them so it can optimize their sale. There's a lot of value. Absolutely. I do not want to underestimate the importance of bringing in an exit coach. I think that's a very smart move. Um, Sometimes the exit coach can be the coach that helps you scale, but probably more often than not, that's not the case. It's probably a different person who's looking at it from a different perspective.
right. So okay, so Colin, the other component is, so if you're thinking about exiting again next year, 2, 3 years from now, do you believe in getting a valuation today and say to yourself, okay, here's where my company stands today, and here's where my competitors are, and let's say your competitors, it looks like they're trading at 2 to 3 times more than your company is, so you're not really at what I call best in class for whatever reason. Maybe the business, like we talked about before, is too dependent on you, and
Or
there's a
one
whole
big customer, maybe one big
customer
customer.
customer concentration is another big one. So when it comes to steps, maybe talked about in your book, do you believe in starting with evaluation to see where your company stands today versus your competitors?
I don't. I mean, the way I look at it in the book is there are three types of buyers. Okay,
Right.
let's start with the one that we get the phone call every week, private equity, cash flow buyers.
Yep.
Tend to be more earnings multiple, tends to use interest rate sensitive, tends to be a little bit more focused on the just return on the investment, and they want to like buy your company, bump you up, sell you off to another private equity firm 3 years later. Okay, I consider those to be sort of the lowest end. And look, if you're going to go through the process, you might as well break them into three columns and say, okay, these are the private equity firms. And by the way, I've done strategic deals with private equity firms before as well. So I'm not saying there aren't some opportunity there, but just traditionally, I find them to be cash flow buyers. Okay. The second are your competitors. Now, why are your competitors more interesting than your the private equity? Because of economies of scale. So they can come in and let's take the school example since I brought that up. We run one school. If a company were to come in and they run six schools, they could really reduce a lot of the expenses that are associated with the school. Um, Another example I can use is .club. When GoDaddy came in, they basically didn't need any of our staff. It was a domain extension. They run .us and .biz and a few other domain extensions, so they didn't really need any of our staff. So they were able to give us a higher multiple um, than a private equity firm because they were able to reduce costs. Now they're not going to give you the full arbitrage. This is important. A lot of people come in and think, oh, if I'm if you eliminate all these costs, then I should get X dollars, and that is correct. That does increase the value for the buyer, but the buyer's going to want some form of arbitrage. And the third type of buyer, the one that I like the most, the one that I focus on the most, uh, are the strategic buyers. And these are buyers that come in and they buy your company, but they get a strategic lift.
Right.
So, for instance, maybe going back to .club, which was interesting because there was sort of a competitor element to it, but there's also a strategic element to that deal that we did. When they bought .club, they could take our domain extension, which is a great domain extension, and we sold almost 1 million domain names by the time we sold to GoDaddy. Uh, but they could take ours and they have much more distribution than we have. So all they had to do is take this domain name, put it into their distribution channel, and watch the asset take off in value. And that's what they did. And they've also got better pricing power, and they're much better, stronger position. So we were able to get a very it's under it was a private deal. It was under NDA, but I will say it was a very high valuation, and it was done just before the crypto crash in
Wow.
2023.
And that's
So
the benefit. I mean, that's what
that's
strategic
that.
buys. I mean, I've heard story after story after story about strategic buyers and paying up more than the PE firm would or a competitor would.
Absolutely.
Yeah, yeah.
Absolutely.
That's like the golden egg. That's like the golden egg on it. That really
Like that
is.
Hostopia deal that we did for 17 times EBITDA, they were taking our technology and they were distributing it to their 3 million customers. Like that's the best form of strategic buyer, right? Someone who's already got an embedded customer base and you've got a product, service, or technology that you can sell to their customer base. Again, they're not going to give you 100% of that arbitrage, but they will give you somewhere in between. It's just interesting because when I worked at Deluxe, that was the company, and they're the check printing company. That they're a Fortune 500 company, and they I was in charge of acquisitions for the internet side, so I got to understand their mentality and the way that they think. And if they can get a strategic lift, they will pay a premium for your company. Uh, you know, if you have to sell, sometimes private equity works, and private equity they buy a lot of companies, obviously, right?
So, Colin, quickly as you can. So private equity. Just someone who's listening right now. What do they need to know if they're going to sell their business to a private equity firm?
Okay, I always like to find a way to do a strategic deal, right? So we had this software platform. It was a relatively small revenue base, and we ended up selling. We had no earnings, but we ended up selling for about 1.2 times revenue. It was a SaaS company, and the reason why we got a decent valuation on it wasn't an earnings multiple, was because they saw us as the consolidator, and the individual who it wasn't myself, the president of that company, was they were going to use that company to consolidate the marketplace. So we sort of made this not strategic buyer pay us a strategic value because there was something in it for them to grow a much bigger pie or create more value for them. I'm involved in one company now where they were talking to private equity, and it's just not working out. But they're talking to a strategic buyer where we can literally add $1 billion, $2 billion of valuation to the company that's buying it by using this technology. And this is another SaaS company. It's not profitable, by the way. Most SaaS companies aren't. They're growing, and that's been historically the way that they've operated. But the reality is there's a strategic buyer there. And I think for most companies there are, but what I would like to do is I like to identify the buyers in advance. And when I identify them, I then work with the broker. So I don't let the broker, can go to a broker and you can say, hey, can you help me find buyers? Sure. But I also like to do a little bit of the work on my own because I know my business. I know my competitors. I can create a list of my competitors. I probably don't have a solid list for private equity that maybe the broker could bring that in, but I could also identify strategic buyers for my business as well.
Love it, love it. So, a couple of key things that we spoke about today is number one is being personal ready. That's really important. Again, you sell your business on Friday. Who are you on Monday? What is that next chapter going to look like? Because you don't want to be lost because your identity was so much in the current company that you run. So you have to really think that through because that's super important from a personal planning standpoint. That's number one. And number two is the importance of a business coach and the value that they can bring to your business when it comes to potentially exiting within 2 or 3 years. Third thing we talked about is if you are contemplating exiting, right, reviewing the key metrics for your industry and what that means to your particular business as it relates to your current earnings. So if you are a large company, hopefully you are with a significant CPA firm. And if not, you should be hiring one because that could really add a lot of value to the bottom line, the overall, and maximizing the value of that. Going with the strategic buyer or finding a strategic buyer would be most ideal because most likely you can maximize the value of your sale. And the last thing I want to just touch upon is 80% of wealth or greater is tied up into a lot of these founders' businesses. So I'm just curious your personal view, right? So, as we all run our businesses, we all have profits at the end of the day, and we have to decide what we want to do with those profits. Here's the business right here, and do I take those profits and invest in stocks and real estate and private equity and private companies, et cetera, right? So invest in assets here, like Rich Dad Poor Dad, build those assets up here so you're not so much dependent on your business. That's one way to do it. Or the other way to do it is just reinvest back into the business, which there are so many advantages because of the tax savings, and then the return on your investment with your company typically can be very, very high. Where do you stand on, and how would you advise owners of businesses to think about this in terms of their net worth being so much tied up into their business?
Yeah, and I mentioned earlier I had a business partner who in the IT services space, who, we've got a company. It's about 800 people, and you know, he's pretty much got most of his wealth tied up in that one area. And I was a little bit concerned for him and saying, bad things could happen, right? I mean, the fact is, a lot of his employees are actually in the Ukraine, and they had a war happen. Things could happen. We don't know. We
Yep.
can never predict the future. Um, the other thing that I will make a case here: start, scale, keep versus start, scale, exit, repeat, is that the tax code is optimized for entrepreneurs with capital gains versus income. All right. So let's go back to the Hostopia scenario, 17 times EBITDA in 2006. We sold that company. At the time, it was a 15% capital gains tax rate under George W. Bush. And we were paying 44% corporate tax between state and federal corporate tax rate. It would take us 30 years to get back the money that we got on that one sale just based on the tax differences. So it's much more tax efficient if you have a formula where you can start a business, you can scale it, you can exit it. And we haven't talked about this, but the repeat section of my book does go into positioning yourself before the exit to air traffic control new businesses that can leverage off the current businesses. And I've done that dozen times. Like I'm in the middle of a business, I see an opportunity. Because by the way, when you're in the middle of it all, opportunities are everywhere. I've seen the entrepreneurs who sell, and 2 years later, they can never get a business going because they don't see the opportunities anymore.
Right. So, Colin, just to go back to what I said before. So, what you're saying, are you saying then when you have a business that is profitable, do you suggest reinvesting back into the business and let that accrue and defer into the business, and then eventually the exit, your taxation will be much
It,
less?
yeah, it depends on timing, right? Like if you're in the scale mode, you want to invest as much as possible into this company to scale it. And if you're in the sort of exit mode, um, that might not necessarily be the right time because of what we talked about earlier. Because if the metric is earnings per share and you're investing and typically accounting's pretty
Right.
conservative,
Right.
you're writing off those assets or you're writing off the those investments, it can make your numbers look horrible, yet your company's positioned for growth and expansion. There is a balance between the two worlds because you want to run the company like you're never going to sell it because you got to have a successful company. But at the same time, if you are going to be selling it, you want to make certain you position the company correctly for that sale.
Okay, Colin, I want to finish off with this. So, a lot of entrepreneurs, founders, when we're talking about their exit from their business, they're always they're always wondering about ways they can mitigate taxes on the sale. So, for example, if they sell for $30 million, obviously they'll have taxes, and then there's the net number. Because obviously you can't say, okay, I always say in financial planning, you're going to say to yourself, what's my net number that I need to be financially independent for the rest of my life? And let's say it's 20 million. Well, if you sell your business for 20 million, your net is not going to be 20 million, obviously. So, from your experience, what are ways that founders can mitigate taxes upon sale?
Like I'm not an accountant. I do have few things that we followed. One of them is I think it's a 1202. Are you familiar with that?
Yeah.
Yeah, so you can earn up to $10 million tax free. And they're a little bit harder to execute though. I have to say because a lot of companies like to buy assets, not the corporations. So they can be a little bit tricky on exit. But if you can pull that off, that could be. It's almost like living in an offshore island and you're living in the United States. It's incredible. where you can pay almost no taxes when you do a sale. Uh, you know, there are sometimes there's a good reason. Like we ran .club as an LLC because it was a SaaS business, and SaaS businesses lose a lot of money. So I was literally taking my losses from the LLC, applying it to my profits from the other businesses that I had, and I wasn't paying taxes for like 5 years. And then all of a sudden, one day I sell, we hit massive profitability. .club, like it's just like it's a consent, it's like going up like that, and we just hit
Right.
profitability. Then I sold it for a huge multiple and paid low tax rate. So, I mean, there is, of course, I had a lower basis, but I had a much lower tax rate. So it depends on the business too. But SaaS businesses, it depends on your personal situation. Uh, but I do like the 1202 exemption. That's pretty cool.
Yeah. Okay. Terrific. So, Colin, this has been. I could go on another hour or greater with you. There's so much to talk about. There really is. But for hopefully, people that are listening to this captured some key parts of this conversation, which I think is extremely helpful. Your experience is great. You've been in the trenches, as I like to say. Your book is terrific. So congratulations on your success in every aspect. And I'll put the last word to you on whatever that means, whatever's on your mind, whatever you want to tell my audience.
Look, entrepreneurship is a trade. It's a trade like any other, and you need to know how to harness that trade. You need to sharpen your sword. Books like Start, Scale, Exit, Repeat, or The Lean Startup, they're great for starting a business. They're great for scaling a business. I know that Rhythm Systems that Patrick wrote, and Scaling Up by Vern Harnish, those type of books can actually really help out. Bringing in a coach is a great idea for scaling. Bringing in a coach for exiting. I didn't mention this to you, but I actually did have an exit coach for .club. I should have mentioned that.
Yeah.
Separate
Yeah.
coach. I had a
Who is
scale
that?
coach. It was a friend of mine who agreed to sit down with me, and we created just phenomenal strategy. We could do a whole show on the things that we did,
We
the
should do
nuances of the actual final sale. Like for instance, one-liners. We had a one-liner that we practiced. We plan these things out in advance. You don't just walk into these meetings and think you're going to sell for millions and millions of dollars without planning it out. And we came up with one-liner. One of them was, "We're going to raise the price $1 a year forever." And by the way, it took us 2 years just to close the deal with GoDaddy, but I kept repeating that, and eventually, after the 7th meeting and there was many different executives involved, they're starting to repeat it back to me.
that.
And that's how we got that multiple. That's how we got that strategic value because they saw the pricing power. Yeah, it's
That's great.
you're an entrepreneur. You're not the CEO or founder. You're not just the CEO or founder of one company.
Love
You're
it.
an entrepreneur.
Love it, Colin. Listen, thanks so much for your time today. Really appreciate it. Let's stay in touch. And again, thanks for your time today. Really appreciate it.